What are the four main types of insurance that you need to know about? The first one is death cover. The second one is TPD cover, total permanent disability. The third one is trauma cover, serious illness insurance. And the fourth one is income protection. Now, all of those four insurances are under the life insurance banner because they protect your life. Now I'll give you a quick brief summary of each of those four different types of insurances. Starting with the first one again, death cover, pays out upon your death. So you can also be paid out when you're deemed terminally ill. So you need 2 doctor certificates stating that you've got less than 18 months generally to live. Some insurances vary, but it can be paid out before you die, so you can get your affairs in order. How is it paid? It's paid as a lump sum to you. How can you pay for it? It can be paid either from your bank account or from your super fund. Is the premium tax deductible? No, it's not tax deductible when it's paid from your bank account. When it's paid from your super fund, yes, it is tax deductible to the super fund. When do you need this type of insurance? 2 main reasons I generally cover off. When you've got dependents, so children and a wife, and when you've got debts, so a home loan is generally the main one that you want paid out if you're not around. The second type of insurance is total permanent disability insurance. In short, TPD. When does this pay out? You being unable to work or unlikely to ever return to work due to an injury or an illness. When does it get paid out? It's when you're unlikely to ever be able to return to work again due to injury or illness. You need to be off work for 3 months generally, and then you need to be deemed by a medical professional to not be able to return to your work. To give you an example, mental health is included in TPD, so picture someone unable to return to work ever again due to mental health reasons. How is it paid? How do you pay for it? Is it tax deductible? It's all the same as the first one we covered, the death cover. So you can pay for it from your bank account or from your super fund. It's not tax deductible if you pay for it from your bank account. It is tax deductible if you pay for it from your super fund. When do you need TPD insurance? Similar reasons for the death cover. When you want to pay out a home loan or when you need to buy a house and enough income to replace your income if you're unable to work. Another thing to keep in mind is there's 2 definitions with TPD insurance, any occupation and own occupation. When it's in your super fund, generally you can only structure it as an any occupation. This is the weaker definition one, which means that you're unlikely ever to work again in any occupation, as opposed to unlikely to ever work again in your own occupation. So think a surgeon, for example. He cuts off his finger, he can't be a surgeon anymore, so he would be paid out if he had an own occupation definition. Whereas if he had an any occupation definition, he wouldn't be paid out his claim because he could be an office worker, for example, or a painter. The third type of insurance is the trauma insurance or critical illness, serious illness. 95% of these claims are paid out in the event of a stroke, heart attack, or cancer. There's about 50 different illnesses in the list. 95% of claims are for those main 3. How is it paid out? It's paid out as a lump sum, same as the first 2. How can you pay for it? The only choice is from your bank account. It cannot be paid from your super fund. Is it tax deductible? No, it's not. But in saying that, when you get paid the benefit, that benefit is not taxable either. When do you need it? If you wish to have a buffer in place, if you suffer a serious medical condition, or you wish to cover some living costs for a certain amount of time for you or your spouse, so you can focus on recovering from a serious illness. The fourth type of insurance is income protection, so protecting your income. Very important one. When does someone need this? Well, if you have an income that you rely upon, you're going to want to protect it. How is income protection paid to you? It's paid in monthly instalments and it's generally 75% of your wage. What triggers a payout to you? When you've been off work due to an injury or illness and you've met the waiting period that you have in place. So generally this is a 30-day waiting period or a 90-day waiting period. How can you pay for it? Two options, once again, from your bank account or from your super fund. Is it tax deductible? Yes, from both the options, bank account and the super fund. In summary, the four main types of life insurance: death cover, TPD, trauma and income protection. You can apply for one on their own or all four at once and blend them together to create a nice protection plan, which is your safety net.